Good afternoon, my name is Jeff Evans and I'm going to take you through the AAT Level 3 Advanced Bookkeeping Practice Assessment, Sample 1. Okay, I've completed the fixed asset register or non-current asset register to save time, but I'll take you through each of the calculations as we're going along. First thing I tend to do with this question is put in the information that we're given. So we can put it straight into the register. So this one, it says we're working for an accounting records of a business known as AMBR Trading. It said you may ignore VAT for this task. And it says the following is an extract from the purchase invoice relating to AMBR Trading for new equipment for its new kitchen. So we've ordered some new equipment for the kitchen. And when it comes to working out the costs, it's the costs involved that are basically have it up and running so it's working. Yeah. So as far as the kitchen is concerned, we've got this nice electric combi steam oven with the colour touch display and the floor stand. So all of those are really important because you can't get it working or up and running unless you include those particular features, I suppose. You don't need the pasta boiler, so that's not a necessary cost. So we're not going to include that in the fixed asset register. You've also got the actual code for that particular product. So the electric steam oven is CS031, and then it tells you the display and the floor stand are for that particular product. So what we're going to do, we're going to add up those. So the 5565, the £999 and the 224, and we're going to put those straight in the fixed asset register. Taken on board that it was on the 1st of April in 2006, and the acquisition is made under a lease agreement. So I'll show you what we do. I'm going to put that one straight in. Forget about depreciation at the moment because I've just put that electric oven in, as you can see. So I'll put the electric oven in, so it gives you the options there. So it's that one. The date was the 1st of April 2006, and the cost was 6788, and it was under a lease agreement, as it said. So the 6788 is literally those costs added together. Okay. The other thing it said, the following information relates to the sale of computer equipment no longer used by the business. So we've got this desktop DT3 that was sold on the 31st of December 2006, and we sold it for £180. So I'm going to go and find that one whilst I'm at it and put that information in first. So it's this one. So it's the DT3. Again, forget about depreciation for the moment. And I'm putting the proceeds in, which is £180, and it was sold on the 31st of the 12th, 2006. Okay. So we've put that information in. So working out depreciation and all the other bits and pieces now. So it tells us that ABM Trading has a policy of capitalising expenditure over £500. So that just means that for any items that we buy over £500, we're going to capitalise and put it in the fixed asset register. It then tells us that kitchen equipment is depreciated at 20% per year on a reducing or diminishing balance basis, and that computer equipment is depreciated over 4 years on a straight line basis, assuming no residual value. So we're not going to sell it at the end of the period. So all we're going to do is we're going to divide it by 4, whatever the cost is, over the year to work out what the depreciation charge would be. There is a question later where we've got a residual value, and I'll show you how that works. It then tells us depreciation is calculated on an annual basis and charged in equal instalments for each month the asset is owned. So we're going to work out what the depreciation charge is for the year and then how long we've had it for, because then we can work out what the depreciation charge will be. So the first thing we'll do is we'll do the kitchen equipment, which is 20% on a reducing balance basis. So with the first kitchen equipment here was 1st of the 4th, 2004. I should point out that key thing is our year end is 31st of March 2007. So back to this one. So that kitchen equipment, that double door freezer was purchased on the 1st of the 4th, funny enough, first day of the accounting year, for £1,995. Okay, do that 20%, will give you the calculation. So it was 1995 times 0.2 is 399. Okay, so this one is £399. Is that right? Kitchen equipment, yeah, 20% on the diminishing balance basis. So 1995 minus the depreciation charge for the year, which is 399, gives us a carrying amount of 1596. So at the end of 2000x5, the carrying amount is 1995. So then you do 20% of the 1956, will give you 31920. Take that off the 1596, means at the end of the year, the carrying value of the asset at the end of 2006 is 12780. So again, it tells us it's 20%. So 20% of 127,680 is 255.36. So again, so 127,680 minus 25536 gives us a carrying amount of 102144. So that's for the kitchen equipment. For the oven that we purchased before, so 6788. So again, we'll work out the depreciation charge. So 6788 times 0.2 is £1,357.60. So that's the depreciation charge for the year, giving us a carrying value of 5430.4. Okay, so that's the carrying amount that goes into our statement of financial position and our depreciation charge in our P&L. We've now got computer equipment, and the computer equipment is done on the, is it diminishing balance? Yeah, so it's the depreciated over 4 years on a straight line basis. So basically we do this one, we work out, so we divide it by 4 to work out the depreciation charge. But again, notice when it was purchased, you see. So this was purchased on the 1st of the 10th in 2004. So we've got, so our year end is March. So we've got April, May, June, July, August, September, October. Yeah, so that's 6 months. Is that right? April, April, May, June, July, August, September. Yeah, so end of September is 6 months. So what you do is you're 1380. So the actual cost was 1,380. It's depreciated over a 4-year period. So divided by 4 is 345. So the full year's depreciation is £345, but we only had it for 6 months of that period. So therefore we divide that by 2, which gives us 17250. So for our year end, 31st of the 3rd X5, we had it for that 9 months, 6 months. So we've got 17250 is the depreciation charge, which gives us a carrying value of 120750. So 1380 minus 17250 gives us 120750. So it's depreciated on a over a 4-year period. Remind myself, as I'm getting older. So depreciated over 4 years on a straight line basis. So again, so on cost, so 1380 divided by the 4 years gives us a full year's depreciation in 2000x6 and also in 2000x7. So again, so your depreciation charge for each of those years is 345, and you take it off the carrying amount from the preceding year. As far as this desktop is concerned that we sold, okay, so again, 1st of the 1st is when we purchased it in 2000x5, and we bought it for 57984. So again, same process, we divide it by 4, so 579.84 equals, so again, sorry, 579.84 divided by 4. So it's 144.96 per year. That's the depreciation charge. But bear in mind, We bought it on the 1st of the 1st. So we've got January, February, and March. So for this one, that only represents 3 months. So the best thing to do is to work out your depreciation charge for the year, which is 579.84 divided by the 4 years, gives you 144.96. Divide that by 12, which is £12.08 per month. And this time for that first one was 3 months. So times 3 months. So that's where you get your 36.24. So 57984 minus the depreciation charge for the year gives us a carrying value of 543.60. In 2006, full year's depreciation, so 579.84 divided by 4, 144.96. So therefore the depreciation charge in the year is that full amount. Take that off the carrying amount from the previous year, gives us 398.64. So now we need to work out the depreciation charge when we sold it. So we sold it on the 31st of December 2006. So our start of our year was the 1st of March 2006. So we got March, we got April, May, June, July, August, September, October, November. We've got 9 months, okay? So again, as I said to you before, the full year's depreciation was 144.96. Divide it by 12 to get it monthly, which you said was £12.08. And this time we've got it for 9 months before we get rid of it. So the depreciation at that point is £108.72. And so far as the carrying amount at the end of the year is 0 because we sold it on the 31st of December. So we haven't got, obviously it's gone at that point. So the carrying amount at the end of 2007 is 0. Okay. The next one is just a couple of little questions, and it said, it's important to obtain authority for capital expenditure in order. So if you're going to arrange for some capital expenditure for your business, so let's say motor vehicles as an example, then it's important to ensure that you get the right person to authorise it. I'll give you the examples it says. So why is it important? And it says, to achieve the appropriate level of materiality, to comply with international financial accounting records, or to ensure the business will benefit as a whole from the purchase. And obviously the important thing about obtaining some capital expenditure is that it's beneficial to the business as a whole. It then says the bank manager would or would not be the appropriate person to give his authority. I think the bank manager would be quite happy to give you the authority, wouldn't they? So on that basis, obviously for your business, the bank manager isn't the person who approves it when it comes to the organisation itself. Okay, so that's 1.1. 1.2 is a question here to do with non-current assets, and it said you're working on the accounting records for a business 31st of March 2007. Again, a new vehicle is being acquired and it's estimated it will have a useful life of 4 years. The cost was $12,448 and this was paid from the bank. It says the business plans to sell the vehicle at the end of 4 years and will have a residual value of £4,000. It said vehicles are depreciated on a straight line basis. A full year's depreciation is applied in the year of acquisition. And it said depreciation has already been entered excuse me, in the accounting record for existing vehicles. I've already put this figure in, so just let me show. If I was doing this in class, I'd probably have the T accounts, which is what I enjoy. So I'm going to look at the vehicles at cost first. I'm going to deal with it first. So he said the vehicle cost $12,448. So I'm going to put that in first. So the vehicles at cost, it already tells us in the question we've got a balance brought down of 46,300. So vehicles we've already purchased, but then we've bought another vehicle to the value of 12,448. Okay, so that's our value, our vehicles at cost. All right. It now says we want to work out what the depreciation charge. So we said before that you do cost which is 12,448, minus the residual value, which is £4,000, and then you divide it by the useful life, which in this example is 4 years. So therefore that will give you £2,112 with a depreciation charge for the new vehicle. So again, if you remember from your double entry, so for depreciation charge, you're going to debit depreciation as an expense in your profit loss account, and you're also going to credit your cumulative depreciation that goes to your statement of financial position. So let's put those figures in. So again, in the actual question, you're given the depreciation charges with the balance brought down of 7,575. So we've currently got £7,775 worth of depreciation charges. We're now going to add that 2,112, and the narrative is the vehicle accumulated depreciation, because that's where we'll find the other elements of the transaction. So therefore, now our depreciation charges for the year so far are 9,687. So therefore, that's the figure that goes into our P&L. So it's not carried down because we're doing it at the end of the year, and it tells us what's going to be transferred into the statement of profit or loss. So 9,687 is the figure that goes to the P&L. And then, so as I said before, so we debit depreciation, credit cumulative depreciation, and you see the narrative being depreciation charges. So at this point, we started off with cumulative depreciation charges at the start of 15,150. We've then purchased that new vehicle. So the depreciation charges are 2,112, which gives us a balance carried down of 17,262. Excuse me. It then says that the business sold an equipment, so it sold an item of office equipment for £1,800. The proceeds of £600 were paid into the bank. If I was doing this at this point in class, I would draw the T account, because I prefer to, where we've got the office equipment sat there on the debit side of £1,800, okay? And it's going to be disposed of. So what we would do at that point is we would credit the office equipment account for £1,800 to close it, and the narrative would be disposal. We'll do this in a minute. And then we would debit the disposal account for £1,800. Okay, that's the first thing that we would do with that particular example. We've then got the proceeds of £600 that was paid into the bank. So again, what we would do, so far as that particular item, we've not got depreciation for this part of it, but again, we would do the proceeds. So it would obviously be debit the bank, and we will credit the disposals account. So therefore, I'd credit the disposals at that point. So just to take you through the process, if you like. And if you had depreciation, so your depreciation will be cumulative depreciation. So that will be obviously on the credit side. So when you're disposing of it, you would debit the cumulative depreciation and credit the disposals account. And that will give you some idea of whether you made any profit on disposal or loss on disposal. So I not have to take through that process. So the first thing it says, so drag and drop. So all these were over here originally. That was over there. And it says drag and drop the names of the debit and the credit columns, which shows the entry for the proceeds that were made. So the proceeds was £600. So obviously we're going to debit the bank because the money's gone in the bank. And as I said before, we're going to credit disposals because we've already got rid of the asset when we put the disposals account. And then you'll see, as we were saying before, we debit disposals for £1,800 and we credit the office equipment at cost. Far easier to see it through the T account, but hopefully that explains it to you. Next one is 1.3. And this one says this task is ledger accounting, including accruals and prepayments and applying ethical principles. So it says enter the figures given in the table below in the appropriate trial balance columns. Do not enter zeros in any unused cells and do not use any figures as negatives. Okay, so for this one, you're not given this information, so I've put this information in. So I put the answers in. So you've got accrued expenses. So obviously an accrual is a credit, so that's 850 in the trial balance. Carriage inwards, in case you remember, so carriage inwards is the cost of bringing your goods in, so your purchases in, so that will be a debit. And discounts allowed is an expense, so again, that is also a debit, and that's 1420. And then we've got prepaid income, so income obviously is on the credit side. So whether you use dead or whether you use click, whichever you used, so dead and click, so dead and click, or pills or whatever the case may be. Okay. The next one says you work on the accounting records for the business, 31st of March 2007. It says in this task you can ignore VAT. So it says an entry, so business policy accounting for accruals and prepayments, an entry is made into the income or expense account and an opposite entry into the relevant asset or liability account. In the following period, this is reversed. This is basically just saying that any accruals and prepayments you've got at the end of one year is then reversed at the start of the next year. And I'll show you what I mean by that. So this one says you're looking at vehicle running expenses for the year, and the cash book shows payments of vehicle expenses of 9468. I can ignore the answers for the moment. So what you're given in this question is the original prepaid expenses reversal of 840. Okay, that's what you're given in the question. So I'm going to put that straight in, the actual vehicle running costs. So we've actually we spent £9,468 on vehicle running expenses within the year. But within that 9468, some of it relates to a previous year, so to the next year, okay? To the next year, prepayment. So therefore, I'll show you. So out of that 9468, we've got these road fund licenses. So bearing in mind, our year end is the 31st of March 2007. And it tells us here the 1st of January to the 31st of December is £516, okay, 2007. 1st of April 2007, 31st of March 2008, £405. So again, out of that 9468, yeah, we've paid this, so we need to take elements of it out. So clearly, so bearing in mind our year end is 31st of March 2007, the 405 is a prepayment because we've paid that up front. So we need to work out how much of that first one, the 1st of January to the 31st of December, so January, February, March, so we've got 3 months that it equates to, isn't it? So 516 divided by 12 is £43 times, is that right? It's full year, isn't it? 516 divided by 12 is £43. So January, February, March times 3 is 129. That can't be right. I've done something wrong there, haven't I? So January through to December, it's a full 12 months. Let me see. So just forgive me for a moment while I sort myself out. Oh, I'm doing it the wrong way. It was the 1st of January. I'm sorry, 31st of March. So it was the 1st of January from the previous year, I think, wasn't it? 1st of January 2007 to the 31st of March. I do that sometimes. I was doing the 3 months, so yeah, I'm right that only 3 months of it relates to this particular year, but we're trying to work out how much of it is paid for next year. So I just worked out how much it was, £129 of it is for this year. We'll do it an easy way. So 516, so January, February, March, so divide that by 12, so it's £43 a month. So we've paid it all up front. So we need to work out, so from March, April, May, June, July, August up to December is 9 months. So times 9 is £387. So we've prepaid out of this £387. So 387 plus the 405 means that we've prepaid £792. Yeah. So we've prepaid it, so we need to take it off. So we're going to credit the expense and debit prepayments. And that's what it would look like when it comes to the account. So here we've got that 792. So that 9468 we paid, we need to take off the 792. Okay. Which therefore gives us a profit loss account. That's the balancing figure. So our actual cost that goes to our P&L is not the 10,308, but we take off the 792. So therefore the expense in the profit loss account is 9516. That's the balancing figure. I should point out, as I said before, that for this particular question, you've got, so this is March 2007 now. So you've got the expense, so you've taken it off the prepayment. So you've got this credit the expense for 792, and then you would have debited the prepayments for 792. And that would have gone into your statement of financial position as a current asset because you've prepaid it, okay? Now that's the important thing because this is where students tend to go wrong. So what you're going to do to the next year, so you're going to close that prepayment on the 1st of April 2007, and you're going to basically credit the prepayment and then debit the expense, and then you start all over again. So here you would have prepaid expenses 1st of April 2007 for 792, and then you start all over again. Students do tend to struggle with that reversal, so I've got loads of example questions to do with accruals and prepayments, so quite happy to send them to you. So this is a similar situation, but this one says now we're looking at income. He said you're looking at commission income for the year, and it said commission income of 2070 was accrued on the 31st of March 2006. Okay, so we would have credited the commission for income, and therefore we would have debited the accrued income. Okay, so it would have been a debit. So he's saying, when would the reversal take place? Well, the start of the next year. So the reversal would take place on the 1st of April 2006. So far as the commission account's concerned, so again, as I said before, so in 2006, you would have credited the commission account and you would have debited the accrued income. So you would have that sort of left in your accounts, if you like, that accrued income on the debit side. So what you would do start of the next year is you would credit that accrued income, and then you would debit the commission account. Okay, debit the commission. Excuse me, the income. And that's all that's saying here. Excuse me, that reversal. Hopefully I'll say it again for this in a minute. So then it said the cash book for the year shows commission of 42,805. But now we need to do the adjustments because that 2007, again, on my T accounts, I've got it drawn. And again, if I was with you now, this is how I draw it. So I would basically, as far as my commission account is concerned, it says when I find it, there it is. So in my commission account, I've got, bank, so you'd have commission on the credit side of 42,805. So this bit here. So the cash book shows receipts for commission income of 42,805. So debit bank, credit commission, and that's what you'd have of 42,085. But then you've got that debit entry for that reversal of that 2070. So that goes on the debit side. So on the debit side, you got 2070. And then it tells us commission for the month of, commission of 1,960 for the month end 31st of March 2007 was received in the bank on the 15th of April. Yeah, so we didn't get it until the 15th of April, but we need to add it to the current year. Okay, so therefore that will be a credit, as the cash book figure would be a credit because it needs to be added to the income in that particular year. So that's why I've done it like this. Again, On my T account, it's far easier, but anyway. So 42805 is the initial cash book figure. We then need to take off that adjustment from the previous year of 2070, but then we need to add on that commission of 1,960 that's due to us by the 31st of March, but we didn't get until the 15th of April. So that gets added to the commission that we've got here. So the closing adjustment, I suppose you should do the double entry for that, shouldn't I? So what you would do is you would credit the commission for 1960 and you would debit the accrued income again. Yeah. So you start in the same process again, aren't you? So therefore our commission income for the year is 42,695. And that's how we do that particular question. Next one says, so you're a junior colleague, so your junior colleague asked why you're considering the receipt dated the 15th of April. So she confused as the financial year end was the 31st of March. Which of the following can you use in your explanation to her? And you must choose one in each row, blah, blah. So one which is an acceptable reason and the other one that's not an acceptable reason. And it said the proprietor of the business has asked you to increase the profit for the year ending 31st of March 2007. Obviously, that is not a reasonable request. The next then says the transaction is an expense relevant to the period ending 31st of March 2007. Again, not an acceptable excuse. And then finally, it said the figure is a current asset in 31st of March 2007. So that would be acceptable because it will be, you know, a current asset that you've got in your financial statements. That's 3 marks, that one. So good luck. Next one on 1.4. I should add what I do say to students. I mean, I'm going to take you through all of this, but you can obviously stop it at any point. You can go back, maybe have a go at the practice ones and see what you think. And then practice, practice, practice. So you can stop me whenever you want, come back to me whenever you want, or not at all. It's up to you. So task 4, it said you a trainee accounting technician reporting to managing partner in your accounting practice. You work on the accounting records of a business client. A trial balance has been drawn up and a balance of a suspense account using a suspense account. You now need to make the corrections and adjustments for the year end 31st of March 2007. Again, ignore VAT. It tells us the allowance for doubtful debts needs to be adjusted to 1% of outstanding receivables. Again, it says refer to the extract, calculate the value of the adjustment. Again, I've already put the answer in for that one, just to show you what that means, but I've not put them in here because I want to take you through it as we're going along. So that suspense account we can see here, it didn't balance on the credit side. So therefore what they've done is they put 450 in to make it balance. We're going to get rid of that now once we find out what the errors are, and then we can put it right, okay? So key thing it tells us, it said it wants the allowance for doubtful debts to be 1% of your trade receivables or your debtors. We've currently put £225 to one side as an allowance for doubtful debts. Our trade receivables or our debtors is 17,900. And we've put 225 to one side, but it tells us in the figures that it only wants to be 1% of our trade receivables, or as our, what do they call it on this one? So yeah, outstanding trade receivable. So you do 1% of 17,900. I'll do that just to remind myself. So 17,900 times, so £179 they want it to be. So they want this allowance for doubtful debts to be 179, but we've put 225 to one side. So therefore we're going to take that off by putting a debit on the adjustment. So when we carry it across to the extended trial balance later, we'll put the correct figure in of 179. And therefore the allowance for doubtful debts adjustment is 46. Okay. We've then got, it says that purchases of 984 has been posted to the office expense account in error. So we've put 984 purchases into the office expense account. So this office expense account here is too much because it's got some of the purchases in it. So I'm going to take it off the purchases by putting it on the credit side and put it where it should be on our purchases side. So again, when you post it later, your purchases figure will now be correct, as will your office expenses, okay? The next thing it says is a prepayment of £450 for airfares has been correctly posted, so it has been posted correctly to the credit side. So they've done the credit side of the entry, so far as actual expense is concerned, but they've not done the debit side, which was the prepayment. Yeah, so that 450 is where we need to make the adjustment. So it's a prepaid expense. We've not done the debit side. We've only done the credit side. So what they would have done at that point, so they did the credit side right, but they didn't do the debit side. So to make it balanced, they would have put it in a suspense account to make it balanced. So now we're putting right that correction. So it should be a prepayment. So I'm going to debit the prepayments here. So we'll debit prepayments of 450, and I'm going to take it off that suspense account that we had before of 450, okay, because we had to open a suspense account to make it balance. And the next thing says the plant of the cost account in the general ledger shows a balance of 24,500. So we're in the accounts, it shows the plant is at a cost of 24,500, but we've incorrectly recorded it as a balance of 24,400. I think that was £900 less than what it should be, or is it more? So and we've put it down at 24,000, so 25,400, which is £900 more. So again, it wouldn't have balanced. So again, it's a suspense account. So we're now going to put that right. So the plant at cost, I'm going to take off the 900. And then I'm going to go to the expense account and I'm going to debit that for 900. And then you'll notice your two credits are 900 and your debits are 900. So now we've corrected those errors. Suspense account's gone and we've now got our correct figures with reference to this extended trial balance. Okay. It now says show the journal entries that will be required to close off the rent account for the year end, for the financial year end, and the appropriate narrative. So we've got this rent figure. I cannot think of it as in its T account. Is it rent? Yeah. So we've got rent, debit side, 14,800. So we're going to close that account now by debiting the profit and loss account. So in fact, I'll do the credit first. So we're going to credit the rent account to close it, just so you can see how it works. So it was sat down the debit side of 14,800. Yeah, and we're going to, the narrative is going to be to the profit and loss account. So that's the expense that goes in the profit and loss account. Come on. Profit and loss account. 1480. So that's the expense that we've put in our P&L. And then the narrative is to transfer the rent for the year end 31st of March to which one? Obviously to the profit and loss account. It doesn't go in the statement of financial position, obviously. So that figure is now correct. Next thing says, so your manager has now reviewed the resulting figures in the draft accounts. It's concerned that the client has significantly understated the irrecoverable debt figure and that this will need investigation. You know the client is pressuring you to get the financial accounts completed for what she describes as an important meeting for the future of the business. So any further investigation will mean that she's going to miss her deadline or it can't be met. So what should you and your manager do next and choose which one you think it should be? Okay, you're not going to keep happy. So you need to make sure that you investigate it properly, which is the first one. So investigate the collectability of debts and delay completion of the accounts. Any adjustment could affect the outcome of the meeting. Okay, so you need to make sure that you basically, as it said there, is you delay the completion of the accounts until you find out what's gone wrong. Okay, so that's that one. And then the final one is 1.5. And this one is, it says the task is about year-end routines. So start again. The task is about period end routines. It says using accounting records and the extended trial balance. So you are preparing the bank reconciliation for a sole trader, 31st of March 2007. And it says the bank statement shows an overdrawn balance of 1930. So the bank statement shows overdrawn balance of 1930. The cash book is showing a debit balance of 2407. So it says the bank statement is being compared with the cash book on the following points. Okay, so let's have a look. So the bank statement is being compared to the cash book and the following points. So we're going to look at here, it says, so use the table below to identify 3 items that should appear on the cash book side of the reconciliation. So anything to do with the bank statement, we're not interested in because it's to do with the cash book. Okay, so the first one, it says a remittance advice from a customer has been received and made as an entry in the cash book for the correct amount. Yet this is not shown on the bank statement. Not bothered because this is about the cash book, not the bank statement. So that was done correctly so far as the cash book's concerned. So we're making the adjustments. Next one says a check from a customer for 367 for outstanding debts for year end was received in April, excuse me, 2007. So a check from a customer for an outstanding debt was received in 2007. So this is after our year end. And so therefore it's not relevant for this particular example. Next one says a faster payment of 2174 for the purchase of non-current asset is showing on the bank statement, but it's not been entered in the accounting records. So again, so we need to show that one because we're talking about what's not in the cash book. So it would be number 3, adjustment 3, and we would obviously, because it's a faster payment, it will be a credit of the bank or cash book, and that will be 2174. Next one said that the bank has made an error on the last day of the month. So the bank made an error on the last day of the month. Start again. The bank has made an error. On the last day of the month, a payment of 1087 on the statement has been duplicated. So that's on the bank statement. We're only talking about duplicated on the bank statement. It's nothing to do with the cash book, okay? Whereas the next one says a direct debit of £422 has been recorded in the accounts of 222. So that one is, so a direct debit has been recorded in the accounts as £222 when it should have been £422. So that is one of the adjustments that we make, which is adjustment 5. And again, that is for £200 to put it right. And the final one says interest charges of 142 has not yet been entered in the cash book. So we've got interest charges, so charges we're going to have to pay. So again, that will again be an adjustment. So we go to adjustment 6, and again, we need to pay that 142 and show that in the cash book. Okay. Next one says the net pay control account. So which of the following statements about net pay control is true, and choose which one. So this is obviously at the end of the pay period. We don't want to have anything carried over. So therefore, I suppose the answer to the question is this one. So it's certainly not a summary of memorandum accounts for each employee. It's this one because we don't want to have, obviously, there'll be a balance of 0 when all the correct entries have been made, certainly in relation to your net pay control account. You don't want obviously anything that's not to be carried over. And the next thing, or the final thing, it said you're now working on the accounting records for different businesses. You said you have the following extended trial balance. The adjustments have already been correctly entered. So it says extend the figures in the statement of profit and loss and the statement of financial position. Let's see if I can see what it says in the correct columns. So do not use zeros in unused columns, excuse me, or cells. So what we're doing here now, and again, is determining so whether it goes in the profit and loss account or whether it goes in the statement of financial position, okay? And again, as I said before, if you've got two credits, then you add them together. If you've got a debit and a credit, then you're going to take one from the other. So whichever way that you decide that you're going to do that. So this one, so far as the bank is concerned, so we do know that bank is what? I can hear you. So bank is a current asset, yeah, in our statement of financial position. It would normally be a debit because it's normally a current asset. But this one is on the credit side, so it means that we're overdrawn. So 958 plus 75 is 1033. Okay. Capital, excuse me, we know goes in the statement of financial position on the finance by. So that is a credit, as you know, from your acronyms of, I said before, dead and click or pearls. So 1100. We've now got our closing inventory. Excuse me. So closing inventory, we've got stock. Our closing inventory is the figure that goes in our statement of financial position under our current assets. So we know that that is a debit. So we're going to put that as a debit side in relation to our current assets. So 9930, current asset. But then in our profit and loss account, it goes on the credit side because it's a cost of sale, isn't it? Opening stock plus purchases minus closing stock. So that goes on the credit side for the statements of profit or loss. Depreciation charge is what? I hear you say is an expense. So depreciation charge is an expense in the P&L. So that's 3895. Equipment, which I know that you know. So equipment, we've got a debit of 20,162, and we've got a credit this time of 689. So it was originally recorded in the ledger balance of 20,162. We've had to do an adjustment of 689, which therefore means that equipment at cost, as you know, which is a non-current asset in the statement of financial position, is now 19,473. 473. Cumulative depreciation, as you know. So cumulative depreciation is your equipment minus your cumulative depreciation. You know that goes on the credit side of the statement of financial position. And again, we've got 15579. Interest paid. So interest paid is an expense. And it says we've got 63 was the original entry, but then we've got another 75. So interest paid is an expense that goes in the P&L. So therefore 138 is the expense. A loan, which we know is a liability. So liability is on the credit side. So we've got 6556, which is our original entry, but then it's been debited to 1085. So we're going to say before, so credit and debit, we take one from the other. So we've got 6566 minus 1085 means that our loan figure is 5481. Nearly there. Office expenses. There's a bit of a mess here, wasn't it? We had office expenses. We had an original entry of 22,495. We then made an adjustment for 689, but then we made another adjustment for 290. So you can either go 22,495 plus 689 minus 290 will give you the correct figure, okay? Or you could just take one from the other and add it to that. So we know office expenses is, expense as the name suggests, in your P&L, which is 22,894. expense in your profit loss account. So closing inventory, we know those on the credit side of the profit loss account. Our opening inventory is a cost of sale. So opening stock, so 10,058. Payroll expenses, so you know from your debit expenses, assets and drawings, that this is an expense and there's no adjustments to make, so 20825. Prepayments, where does that go? So prepayment we know is a debit. Yeah, you're right. So prepayment goes as a current asset in your statement of financial position. So 290 is a prepayment. Purchases is a cost of sale. So debit, as you know, if you do PERLs, purchase expenses, purchases, expenses and assets for the PEA. So your purchases is 79454. Purchase ledger control account or creditors control account. So your suppliers, we're saying that we owe our suppliers 13,167. So as you know, that's a current liability in your statement of financial position. So 13167. Sales, so you know where sales go so far as your profit loss account is concerned. So your sales on the credit side. So you got 126,139 and then an adjustment for 485, which gives us 126,624. Okay, let's have a look. Sales ledger control account, so your debtors or trade receivables is a current asset in your statement of financial position. So that gives you 16979. Okay. Suspense account's gone as it should be because 600 on the debit side and then we had 485. And so the suspense account has gone as it should do. And then we've got VAT on the credit side. So again, as a current liability in relation to your statement of financial position. So 1122. Okay. So I think we've put all the correct entries in. So we now need to look at, so let's have a look at our money coming in and money going out. So that's income, isn't it? So money coming in, if you like, here. So 136,604, but going out expenses, so on and so forth, is 137,294. Okay. So basically, we've got more expenses or costs than we have income. Okay. So therefore, we're going to put in the balancing account here, which I do know because I've got it in front of me, is 710. Oh, I put something in wrong there, haven't I? Let's have a look. I put a wrong figure. It's that one there. It's not 980, it's 9930. I bet you noticed that when you did it, didn't you? That's right now. Okay. So therefore, we've obviously got a loss when it comes to profit loss for the year. So it's a loss. And therefore, obviously, we're going to credit the profit loss account. And then you'll see as a process of elimination. So the balancing figure in here, 710. And then it all balances even. Okay. So that's it. I'll post this on wherever I post it, YouTube, and share it with you. If you've got any questions you're not sure about, then please ask me, so I don't mind. So you can reply in relation to YouTube and say anything you're not sure about. And hopefully I've done my bit to try and help some people. I have got lots and lots of other questions, particularly to do with suspense, accruals and prepayments. So I'll probably put that on there as well. Okay, so the very, very best of luck in this most difficult times. And then hopefully you'll do well when it comes to doing the exam. Thanks very much. Bye-bye.